Hello, Baker Finance students. Halfway point of this week, we'll be halfway through the course. I hope everyone had a good spring break. I know I did. It was nice to get a little break from class. Just get yourself refreshed and ready to go again. But this week, you will have 3 chapters. You'll have chapters 9, 10, and 11. In chapter 9, you're going to look at a discussion of, how does the company come up with this weighted average cost of capital? What is an appropriate rate of return for the company to use when it's evaluating projects? And you're going to revisit some of that idea of the capital asset pricing model, different ways to look at the valuation of the stock. Could use the dividend growth model. But when we talk about the weighted average cost of capital, companies finance themselves through bonds. It could be through equity, what we call stock. It also could be through preferred stock. And it needs to provide an appropriate rate of return to the investors relative to what investors are paying for that. One of the companies I was reading about on CNN FN today was the Dryden Company, which manages the Red Lobster and the Olive Garden. And right now they're just not making a good required rate of return for their investors, and that's why their stock price is suffering so much. But other companies like Panera Bread Company, which I bought their stock a year ago, is over $600 a share. So that company is going to have to figure out, do they need to spin off Red Lobster? How are they going to get to a point where they meet the required rate of return for the investors? So what you're going to be doing in this chapter is kind of looking at all these components and placing weights on them. So if a company is half financed with bonds and half financed with debt, you got to find that maybe perhaps capital asset pricing model, but we're half financed with equity, and the required rate of return is 15%. So you take 15 times 0.50. And if we're the after-tax cost of debt, one of the benefits the corporations get from using the debt is they get to deduct the interest expense. So it actually makes the opportunity cost a little bit lower for that company. So perhaps if that is only 5%, I'd have 50% times 5%, and then I would add those two things together to come out with an appropriate required rate of return for my investors. And that's a lot of what that Chapter 9 does. Chapter 10 gets more into the examples of how do I figure out that this is a good project that I should take on. I figured out an appropriate cost of capital. I have these cash flows coming in. I expect to last for 5 to 7 years. Well, I have to discount back all those cash flows back to the current time period. What are those cash flows worth to me today? If the cash flows that are worth to me today are greater than initial costs, I should take on the investment. That is, that the net present value is positive. I could also use an internal rate of return, which by definition, the internal rate of return sets the net present value exactly equal to 0. So if I require a 10% rate of return for my investors, my project gives me a 14% rate. That's also another way to look at it and say, yes, that I need to take on this project. So, and we have to be careful with that statement because there's also some things we can do that are with sensitivity analysis and scenario analysis, but we at least feel a little bit more confident with our decisions. The payback period just looks at how long it would take to pay back, but it doesn't take into consideration any opportunity cost. And there may also be things too that you read about called modified internal rate of return, MIRR. And because we make those assumptions about internal rate of return, we're making the assumptions whatever cash flows we can get are reinvested at that same rate again. That may not always be the case. We may have to actually invest at a lower rate. So you'll read about a lot of those things in that chapter. And then finally in Chapter 11, it gets into the more nitty-gritty of, how do we calculate these cash flows? Kind of basic economics. Here's my revenues. Here's my cost. I can do this on an annual basis. I can do it on a monthly basis. But again, it would give me some projection of this project. Bottom line, cash is king. So what are the cash flows at the end of each time period? Again, I want to discount those back to see what they're worth to me today. And again, if the net present value is positive, I take on the project. So, but again, there can be a lot of different things that can happen. So as a manager, when we take on a project, we want to know about the what ifs. And in the forum discussion this week, I want you to kind of give an example of maybe something you've done in one of your businesses in the past, or you work with others to make a decision about some type of investment decision. It could be going after a new market. It could be buying a new machine. It could be even something in your church that you wanted to fund, and how long would it take to pay that item off? So a lot of different avenues you can go with this. So, but again, looking forward to get back into discussions this week. And if you do have any questions, do email me, but we will talk to you online, and have a great week. Take care.